What's going on, everyone? Hello. Welcome to Al Stock Trades. How's everyone doing? What's going on? Mic check, 1, 2, 3. All right, late night video. We've just been pumping them out recently. Lots of things to talk about. Lots of changes in the market. I'm glad to be able to be here to talk with you guys. And we're just going to get straight down to business, okay? So the question that's happening right now is, what the hell is going on with the Clover Health stock? What's going on today, guys? I mean, seriously, let's go ahead and take a look at the stock here, and it just went up 10.89%. I mean, with all jokes aside, someone said 10% is nothing, right? With on stock. The one I just talked about just yesterday at $64 went to $66. Ooh, beautiful, just beautiful, right? Almost $67, right? So we're going to go ahead and talk about this. Let's, without further ado, let's get to it. So first things first, I just wanted to basically, to all the Americans that are watching, I want you, if you have children that are in elementary school, something that's really important to me is education. Hence why we created the Mastering Stock Market course that you can get $1,000 off right now for Black Friday. But elementary and secondary school emergency funds are set to expire very soon, and it's very interesting because 56 percent, at least in Arizona, 56% have used the emergency relief funds given by the Federal Reserve. I'm sorry, hello, federal government. We are going to be talking about the Federal Reserve, right? But just for all the people that are watching, I know there's other people that are outside of the USA. My apologies for this slide here, but something important to me is there are some countries that have not used a lot of their emergency relief funds to spend on their students. Students are the future. Are they going to spend some money for financial literacy? Probably not, right? But whatever. If you have control of this and have your students in there, talk to your teachers, speak up, use the money given to the children, right? Anywho, sorry, there's a little side note there. My apologies. All right, so financial conditions are loosening again. This is the Bloomberg United States Financial Condition Index. Again, you got to have Bloomberg to get this data. Don't worry, we'll be able to provide it for you. Don't worry about it. If you look at it here, guys, whenever we go down, this is like just tighter conditions, and whenever we start going up, it's looser conditions. So you can go ahead and graph the stock market returns for returns for when the number is near above zero for looser conditions, or when it's below zero. I just want you to flip the switch right now and just think about March right here, 2023. You see how the March the number dropped here, which basically shows that we're going to get tighter conditions, and all of a sudden it pretty much basically increased. A way to predict this, and yes, there's a way to predict it, is you can use what's a good way to look at it? You can use the 2-year to help. You see, if you zoom here, and this is in March, this happened right in March, you can use the 2-year to predict the treasury yields, which I'm going to go into. I just want you to remember March 2023, okay? Just remember that, okay? And then we'll talk about it soon, right? A lot of data. This is a very difficult conversation. That's why stock market retail investors tend to fail, because they don't understand the bond market, and they don't understand, just fundamentals, and they don't understand the Federal Reserve. So in this video, we're going to relate it how this is why the Clover went up, okay? So if I were to dumb it down to I guess the proverbial term is like ape knowledge, I guess, for us apes. Yeah. It's essentially the stock market, Wall Street believes the Federal Reserve is full of shit. That's pretty much it regarding if they're going to tighten. Okay, let's continue. So if we look at the volatility index, I believe the CBOE, which stands for Chicago, they created this VIX, which we all know about the VIX. Some of us, right? Whenever we see a downward shift in the VIX like this, it's usually a buy signal, and we just flipped the switch for a buy signal right now, and there's a high probability that we may rally. Okay, so now. we're going to switch gears really quickly. And I want us to go ahead, and I made this diagram. That's why I put the quote here for Warren Buffett. And I want you to follow me. Okay. I'm going to drink a little sip of my cardamom. I put cardamom coffee espresso in my Italian espresso machine. So I'm going to take a nice sip. If you haven't put cardamom in your coffee, you're not living life. Okay. Hold on. Oh, damn, that tastes so freaking good. Okay. So it's a little Middle Eastern Israeli thing I learned. Okay. So I want you to look at the put call ratio. All right. And analyze this. Okay. Whenever we spike, it means fear. The people equal fear is equivalent to all my technical analysis day traders out there oversold RSI. When you have an oversold RSI, relative strength index for the technical analysis indicator, historically, especially if it's on the daily and yearly, you will be below intrinsic value. Now, again, you have to calculate intrinsic value to figure that out. And when you have fear, if you look directly up, it's a buy. When people are fearful, it's a buy. Fearful, it's a buy. People are fearful, it's a buy. People are fearful, it's a buy. People are fearful again here, 2020 pandemic, it's a buy. People are fearful, what do you think it is? It's a sell. No, it's a buy, right? And then all of a sudden here, we just hit it again. People are fearful, and what it is, it's a buy. This is the put call index, put call ratio. When puts are high, you have to do opposite of what people do. Robo stands for retail. These are retail trades. Whenever they have a lot of high puts, whenever you see dumbasses and idiots say puts, when the stock price is dropping, you got to think opposite. It's the second statement of Warren Buffett. Be greedy when others are fearful. Now you may be asking, if you're interested in this, you may be asking, okay, well, what's this? Why were people fearful here? 2008 great financial crisis. Why were people fearful here? The taper tantrum from the Federal Reserve. Why were people fearful here? Well, because people were dying, COVID. Why are people fearful here? Inflation. And I put all the dates here, great financial crisis, and I explained each reasoning for each fear spike. And if you were to go to our mastering, if you go to our mastering stock market course, and if we were to go down, I can't believe I created all this during medical school. I mean, god dang, dude. And I'm not even done yet, right? These are all our billionaires that we follow. Let's look at the, not the recessions. We could look at the recession sniper. Let's hear. Federal funds effective rate. No, it's not this one. I don't think so. Hold on. Give me uno momento. Trying to look for it. Oh, variable shifter. There it is. So not this one. This is our sniper. Remember I told you whenever we turn into a sniper, we bunch up, we explode into a recession. So we did bunch up here. So we could be bunching up. We could be exploding soon. But we'll talk about that. All right. So as you can see here, this is the Federal Reserve tracker. This is a nice interactive tool that we have for our mastering students here. We can play around with. So you could scroll down. This is in between 2016 to 2019. You can see as rates go up, you can see the stock market returns go down, right? And as they leveled off, you can see that it's more on this side, right? And then as the stock market, as the Federal Reserve dropped interest rates, what happened to the stocks? Poof, they shot up, okay? You could relate it to the dollar too. Then you have cyclings of increases. If once they increase, the stock market trades low. And when you have the interest rates start going down, it means something's breaking. So the stock market, whenever the federal funds rate goes down, whenever they cut, historically, it means that, stocks fall, as you can see here. So that's what we're afraid of right now. We're like, well, the federal funds rate means it could be falling, right? So that's a good little thing. And then when rates are stable from 2009 to 2015, like zero, stocks go up. Okay, so nice little pattern. Again, good to go over. Okay, but very clearly here, let's go back to the research here. Okay, so we went over this. This is a very good graph to learn, right? You understand this, more than 90% of people. Okay, trust me. Okay, trust me. All right, so now let's talk about the federal funds rate. So if you go ahead and look at this graph here from 1960 to 2023, this is the federal funds rate. Whenever you have the FOMC meeting and Federal Chairman Jerome Powell stands on the podium and says, here at the Federal Reserve, the Open Market Committee, we want to maximize employment and yada, yada, yada. Yeah, that meeting. You can see that they increase interest rates here, right? But if you look at it, every time they drop, there's usually a crisis. So, the ones that kind of like are known by a lot of investors, you may not have heard of the SNL crisis or the Continental. And I actually recommend you the silver bubble, and even there's some oil crisis here too, I believe in the 60s and 70s. My recommendation is you learn these, right? Because history repeats itself. But for the ones that a lot of people know about is the dot-com bubble crash and the subprime mortgage meltdown, right? So what's feared here is that if this thing drops, it means that something is breaking. Just like how it dropped here, it means COVID happened. Potentially there could be another crisis that drops this, and then that could be the scenario where we go into a recession. And for people that are interested, you can like take a screenshot or whatever. You could read about this and learn a little bit about history of how the federal funds rate collapsed. These are things that are not taught in high school, that are not taught in our educational system, and honestly is sad, right? And will help you make money in the long run. Okay. All right. So now I want us to basically take a look at this. There's a lot of data here. Okay. This is the United States federal funds rate versus the Treasury yields. Okay. I remember, if you don't remember talking, when I was in Minnesota, I was talking to you guys about this, and I said the 2-year right here, the red line, the 2-year Treasury is predictive of the federal funds rate. You see, whenever you go to if you go to any economist, they're not really wealthy. No offense, right? Because they just focus so much on the numbers that they just forget the grand scheme of things. So we're not economists here. I'm not an economist, right? But I use, just like math, right? Math is a tool, right? If you talk to a mathematician, he's just a math guy, right? But if you talk to a physiologist, you talk to a scientist, we use the mathematicians to answer questions about reality. As a stock market investor, I use economists to answer questions about reality on how I can make money. Okay, so I use economic data to make me money. I don't use economic data to learn about people. I don't give no offense. I don't give a crap about what people do. Right? I want to I know this sounds really harsh. Right? I'm putting on my business hat. I want to make money, and I want to so how can this economic data help me make money? So I can be financially free, so I can do what I want to do, right? Which is help people, yada, 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 and all that, right? So I'm trying to give you kind of business perspective. Don't focus too much on like you're going to be a Meet Kevin. Meet Kevin is just all about economy, and the guy doesn't know how to make money, right? He just, grifts, right? So, all right, so let's go ahead and let's focus on this, okay? So as you can see here, as I said, the 2-year leads the federal funds rate. When people want to know what the Feds do, they look at the 2-year. Why? Because the hedge funds control the 2-year. The bond market is bigger than the stock market, ladies and gentlemen. And the bond market has literally talked today and said the Federal Reserve is full of shit. Okay, now look. Let's zoom in. Let's zoom in. So as you can see here, in 1990s, you saw how the 2-year the 2-year is always higher than the federal funds rate. It tells you when the Federal Reserve might raise. You see how it's always ahead. The federal funds rate is below it. It's kind of like the turquoise line that you see here. So you can see the turquoise line. The 2-year. I'm just going to say red over the turquoise or blue. Let's call it blue. Red over the blue. Red over the blue. Right? So guess what happened? So now let's zoom in, and you can see here in January of 2021, you could have seen, and there's a lot of other indicators that we have, the hedge fund index, so many indicators that we use. But again, we use multiple to create a hypothesis. But you can see the federal funds rate started going up, indicating that the 2-year believes the federal funds rate is full of shit. That look how long they kept rates near zero. I mean, this is just a mistake of the Federal Reserve. They were saying that inflation is transitory. It is ultimately transitory, but not the transitory terminology they were using in terms of it being short. The 2-year was like, no, I don't believe you. I don't believe you. And then, so you can see how the 2-year is predictive, right? And then all of a sudden, the 2-year went up a lot in March. And all of a sudden it dropped in March 14, March 15, it dropped. So remember how I told you the data I showed you here? Remember I told you to remember March? For people that tuned in the beginning of the video, congratulations, right? Very strong work. You could see here during March, here March. During March, it dropped a lot for tighter conditions. And why did it drop hard in the beginning of March? Because look what happened. Look what happened. In the beginning of March, it rose like insane. It rose crazy. And then it dropped crazy. And then what happened? It rose automatically. So again, for proof of concept, POC, if you want to call that, we can look at kind of the year to date, and we can see where's March? Here it is. You see how March, it dropped 7%. We're talking NASDAQ, guys. The freaking NASDAQ dropped 7%. And then all of a sudden, the 2-year dropped significantly. And then from the 2-year dropping, look what happened. It went up 8%. So what I'm trying to tell you, and I know this is complicated, but if you can wrap your head around this, you really have a power. So the 2-year dropped. So then the NASDAQ actually got stronger, which shows you that the Federal Reserve shows you that the 2-year believes the Federal Reserve is full of shit. So the Federal Reserve started fighting, and they said, "No, screw you. We're going to continue raising." The thing is, there's so much. I mean, if you look at the 30-year, let me just look at the 30-year mortgage rates right now, guys. The 30-year mortgage rates is 8.5%. Now, for all the oldies out there regarding the mortgage rates, I understand that in the 80s it was 16-17%, but houses were like less than 200,000. You can't have high houses. You can't have an expensive house with high mortgage. People are not going to move, and they're not going to sell their homes, which is going to further decrease the supply. It's going to fuck up the economy. Okay. Also, the federal when does the United States play in the World Cup? No, I'm just kidding. When does the United States recycle their debt? No. Fiscal debt. Okay, they do it actually. They do it in They do it this year in 2023 and 2024. They're going to recycle their debt. It's not showing me the article, but I think it's somewhere in here. But we're not going to. You can read about it. But what I'm trying to tell you is the United States does not have money to pay off its debts of $33 trillion off of 8% fee. It just can't do it, guys. It just can't. So what I'm telling you here is that the bond market now is going to start fighting the Federal Reserve. And what's going to happen is you're going to get these things called bond vigilantes. You're gonna be like, what the hell are bond vigilantes? What are they? Again, I'm teaching you some things that a lot of people don't know about. Again, so this was coined by your Denny. Okay, now look. A bond vigilante is a bond market investor who protests against monetary and fiscal policies considered inflationary by selling bonds, thus increasing yields. Okay, in the bond market, prices move inversely to yields. When investors perceive that inflation risk or credit risk is rising, they demand higher yields to compensate for added risk. As a result, bond prices fall, which is why, what's his name? I'm blanking here. Bill Ackman shorted the bonds, and yields rise, which increases the net cost of borrowing. So what ends up happening is these bond vigilantes come in and they're like, no, I'm not going to buy your bonds. I want them to increase, right? But what's happening right now, they've increased to a point where the bond market knows this is so unsustainable that these things are going to end up dropping. Okay. And as the federal funds rate starts dropping, I mean, we can look at here the last time it dropped. You can see how it just shows you how smart these folks are. The 2-year dropped here, and the federal funds rate continued. It dropped before the federal funds rate dropped, and then it dropped heavily as the federal funds rate. So, I mean, it dropped fast, guys. So what I'm trying to say is the 2 years telling the Federal Reserve, go F yourself, right? I don't believe you. And Jamie Dimon said he still believes the Feds can increase rates, but why am I talking about this? And why is this under a Clover video? Well, it's very simple. So let's open up the intrinsic value calculation. Okay. I know this is complicated, guys, but again, I don't want to cheat you. I want you to learn this. You want to be an individual stock investor. You need to understand this, right? This is not it's not pancakes, right? This is as Sean was saying, you got to use your brain, and don't worry, you have a good brain. I mean, you can, if you're not like handicapped, like in terms of not handicapped, if you have like Down syndrome, trisomy 21, potentially you might be able to understand this. But if you're adequately able, you have the privilege and honor to learn this material. Nobody in America should everyone in the world should be able to understand this and like crack the system of Wall Street to make money. Okay. Anyhow, no offense to people that have Down syndrome. No offense. I'm just saying, like, whenever you have that inner voice, the inner demon between your two ears that tells you can't learn something, that's full of shit. Tell it to shut up, or everyone gets it. All right. So let's go ahead and do the 5% to estimate the future free cash flow of Clover. Let's go ahead and get that. We get 100. I mean, I've done this millions of times, right? At this point, you can do it in your sleep, right? 10%, and then it has let's say I know it's like 488 or whatever. Just say 477 million shares. Now, the growth rate of Clover, we're just gonna say 15%. We're gonna make it simple, okay? 15%. Okay? I want you to focus on the green line. Okay, listen to me. What happens when the 2-year? What happens? Okay, let me make this pretty for you guys. Let me make it cool. Bring it here. Okay, here. Okay. So what happens when the 2-year starts crashing? What happens when the federal funds rate starts cutting? What's going to happen? Money is going to be cheaper. Interest rates are going to go down. People are going to be able to borrow more money. Businesses are going to be able to take on more debt without having a lot of paying interest rates. Meaning, money is going to be cheaper, which means the intrinsic value, the discount rate is going to go down. So let's say, for example, the discount rate goes from 10% to 5%. Look, I'm going to hit enter, and I want you to look at the bull case. Just look at the bull case. It went from $21. So hold on. Look, 10%. It went from $6.87, and look at the discount rate goes down, and then it goes to $21. See, I'm gonna just by cutting the discount rate in half, you took a $6 stock and turned it into $21, meaning you 3.5x'd. So for every half, you 3.5x the return on investment for high growth companies. So what does that mean in the grand scheme of things? Well, it means that growth stocks are going to start coming back. Okay, so now let's go back. Let's go back to our mastering stock market course. There's so many tabs in here. Let's look at the value versus growth. Let's see if I can find it. Value versus there it is. Value versus growth. Okay. All right. Here's here's a 1. Whenever we're above the 1, growth wins. Whenever we're below the one value ends. So if we go here, we can see that growth was winning, and all of a sudden value started winning. But guess what? Growth is finally starting to come back. But like I told you, growth came back in the large caps. It didn't come back in the small caps. So then we go to our other one here. We go to small. That's small. Large caps versus small caps. We go to this graph here. Okay. Large caps is above 1. That's when large caps make money. But guess what? Large caps are winning right now. What happened when we're here? February 2021. What happened here? Small caps were winning. Right? January. I want you to look at January, February. What was Palantir's price? Mid cap, small cap. What was Palantir's price January 2021? It was at the highest it ever was. Okay. Clov is a little weird because with the Hindenburg and everything. Look at Clover. Wait, where'd it go? Here it is. This is Clover. $13. $13.50, $13.90. Are you seeing the pattern, ladies and gentlemen? And you see how it's just started dropping after that? Because look, because it went no, wrong graph. Look, because large cap started winning. Large cap took it. You can hit this link here, and this should take you here. You can see here. Here's the line. Here's the simple moving average. This is the Vanguard 500 large caps over the small caps. Small caps were winning here. Large caps went above the line. So you can see the pattern. This is why that the Mastering Stock Market course is very powerful, because you see the whole picture, and if you're able to connect all these dots, you can make money in when large caps make money. You can make money. That's why I was able to make money on Nvidia. I was able to make money on oil, and sometimes you can make money in international stocks, the M2 money supply. So that's why we have the Black Friday coupon code for people that are interested. $1,000 off. It's going to go up. The prices are going to go up heavily. But what I'm trying to teach you guys here is there's a pattern. There's a big pattern. And again, the argument here that I'm trying to tell you is that, I don't care if I'm buying Clover right now. I would rather be early and get at a cheaper price than be late and get at a fair price, because price is what you pay. Value, finish it, guys, for the mastering students. Value is what you get. Price is what you pay. Value is what you get. Very simple. Very simple. It's really, you don't need a high IQ to learn this. In fact, people that have higher IQs and people that go to college and medical school and everything like that, they actually are risk averse. This actually, the stock market goes against them, right? The only thing I agree with that guy, Robert Kiyosaki, whatever his name is, he's rich dad versus poor dad. Everything else he's been saying is for people that follow us, you already know my stance on that. It just it doesn't make sense. So so you can see the connection here. You can see the connection. I hope some of you can see it. Again, these are all the people. No, that's different. These are all the people that we follow. These are the billionaires of our time. Bill Ackman here. The philosophy of Bill Ackman. What is his philosophy? Right? If we learn the philosophy of these people and we analyze them, you are who you surround yourself with. Okay? So I hope this video was helpful. Also, shout out to Dumb Money. They're coming back strong. Remember, so for people that don't know this graph, smart money is people that have over $100 million in their account. Dumb money is like people that have less than 100 million. Your broker that trades your stocks sells information to this hedge fund I follow, which sells his data to me. So I like to buy when smart money is buying, because that means stocks are low. I don't like to buy when dumb money's buying, but guess what? Dumb money's back in business now. Dumb money's buying. Okay. So again, there's a lot of data, guys. Okay. And you have to take this data and stack it on each other. Each data represents a different part of the body, right? Like this data represents maybe the frontal lobe of the brain, right? And then the large cap, small cap represents the skin. And what ends up happening is you get all this data and you stack it up together and you build an image of the market. I mean, heck, we're getting cheaper prices of Clover Health better than Chamath. Chamath Palihapitiya, the only reason why he sold Clover, and he only sold it down to a 4.99%, and he sold some of his stakes in other companies because he had a liquidity crunch. He got effed. Go ahead, Chamath, prove me wrong. He got effed. That's and sadly, people that were on margin that owned Clover, they got screwed. They got destroyed. People that owned margin. That's why I don't believe in margin. If you want to gamble, go to Las Vegas, right? Or do margin, right? So anywho, so that is the power of being, an individual investor. You have control. You can hold. You can take advantage of this. And this is the time to take advantage of things. I do want to say one thing that I forgot to talk about. One more graph here. Here it is. Recession minus the federal funds rate. Look at this. So the NBER declares when there's a recession. So the gray line is a recession. But look, every time we dip, it's usually once the 10-year minus the 2 years starts rising, and the 10-year minus the federal funds rate starts rising, then we get a recession. Then they call a recession. So we're slowly, as you can see here, we're slowly starting to rise again. Again, there's still an inversion, which is screaming recession, right? Predictive of recession. If you look at all the times we've inverted, we've always had a recession. So I mean, since we've done that, a lot of people are banking on a recession. But from a statistical standpoint, the end power of the probability analysis is quite low since our sample size is low for all my scientists out there, right? So the point that I'm trying to kind of send to you guys is why would it rise and then fall? Well, because they're cutting. They're cutting, guys, all right? So what is a 10-year minus a 2-year? Well, the 10-year minus, so the 10-year is the future, right? And the 2-year is closer. Well, if the 2-year is higher than the 10-year, that means people's outlook on the economy is shit. So if you have a 5 minus a 5, you're going to get a 0. You're going to get an inversion. So, but what happens, let's say, for example, when they start cutting? Well, then the 2-year now, which follows the federal funds rate, like we said in the beginning of the video, starts to go down. So 10 instead of 5 minus 5, it'll be 5 minus 1, which equals a 4. Look at that. Which is a higher rate, right? Which is a higher difference, which means it's going up. Hence why then the recession gets called out. Okay. So I hope this all makes sense to you guys. We break it down in the market course, and we have the group here. So we try our best to teach this. This is very complicated. It's it's a shame they don't teach this. That's why I kind of led this conversation with this. If you have kids, yell at your state. Why the hell are these people not spending the money the government gave them? And about a year from now, it's going to be. I think they only have a year. I think before. What the hell, Puerto Rico? Is this Puerto Rico? Why the hell did they spend 38%? Well, what the fuck? Okay, I don't know. I'm all about education. Spend the goddamn money for the children. But anywho, that's all I have for you guys. Remember, Black Friday sale, link down below, $1,000 off. Take advantage. It's going to be expiring soon. Very excited for Clover. Just a very last analysis for Clover. We're going to go to our terminal right now. And let's go ahead and look up again, it changes. I'm going to probably do it again tomorrow. Hold on. Let me go ahead and type this and type in Clov. The average right now for the earnings movement for Clover, 0%, because it grew a lot. No, honestly, it needs to reset. The market's closed right now. So I would check it again tomorrow to see the average move. But we did move a lot, guys. We definitely moved a lot. It could be sell the news, in the next week, earnings come out and the stock drops. We could get a little bit of that, but we'll see. With the whole Federal Reserve right now, with the 2-year basically telling the Federal Reserve go F off, we're going to see how, the bull market may start. Who knows? There's a lot going on here. All I can tell you is in the next 2 to 3 years, in the next 2 to 3 years, small caps are going to be dominating, and you're going to see CNBC, you're going to see a lot of YouTubers start coming back, and they're going to start, blah, 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 blah. But you know what's so funny? I want you to pay attention to what they say. Pay attention if they understand their fundamentals. You've been listening to me for how long? And you can determine when someone knows what they're talking about and one doesn't. And everything you can do, pause the video and fact check me. And a just very quick shout out, just very quickly, we're about to reinstall our own AI. And guess what it's going to be called? Our own AI for our stock terminal. So if you need some help with financial literacy and, stuff like that, it's going to be called, essentially what I'm doing, I've developed our own natural language processing model. And what's going to be called? It's going to be called Ask Al. Ask Al. Because obviously, I'm humble, right? I just couldn't think of a better name. Ask Al, right? All right, guys. Love you a lot. Hopefully you enjoyed that. I'll see you on the next one. And let me just go ahead and my favorite song, play that nice song. Thank you so much. It's always a pleasure to support, this whole movement for retail investors. Before, this knowledge was not available, and now it is, and we're democratizing financial information. And just wait till the bull market happens. We're going to make so much money. Oh my God. We're going to be killing it. We're going to be rich. I tell you. Have a nice day.